Good afternoon, and thank you for joining us on today's webinar. My name is Adriana Vega, and I am the VP of Government Affairs here at the Canadian Venture Capital and Private Equity Association, CVCA. It is my pleasure to welcome you to today's CVCA webinar discussing Mastering the Purchase Agreement, Key Insights for Private Equity Professionals. This is part of the CVCA's Invest Canada Conference webinar series. And as many of you know, Invest Canada is the largest private capital conference in the country. So a reminder that we will be in Calgary this May for IC25, and registration is now open. So grab your tickets before they sell out. It'll be great to see you there. Today, we are very happy to be working in partnership with FASKEN. And I should note we have an unusually high number of participants registered. So clearly, this is a topic that is very relevant for industry professionals. So we're delighted that the speakers today are going to be sharing some insights. Some of the messages that they will convey to you today is discussing purchase agreements for PE professionals and equip you with practical insights to help you navigate the complexities of M&A. Just a reminder to everyone, there will be a Q&A period at the end of the session. So please ask your questions. You can use the button for Q&A at the bottom of your screen. And we'll be looking forward to addressing these. So without anything further, I just want to give a warm welcome to our speakers today, Kiran Singh, partner of M&A, and Claire Gowdy, also partner M&A. So I will pass it over to you, Kiran. Thank you again.
Thank you so much, Adriana. So welcome, everyone. Thank you for giving us this hour of your time. We hope it's going to be both productive and very useful for you going forward. If it's not, lawyers are not a big fan of giving a guarantee, but if it's not, Claire or I owe you lunch, depending on where you're based, whether in Montreal or Toronto. So thank you for being here with us today. As Adriana mentioned, I'm a partner in the FASKEN M&A and PE group in Montreal. My colleague Claire, who's my co-panelist today, is a partner in M&A and PE out of our Toronto office. The idea with this session today, as you all know, an hour, we hope is going to fly by, and that is not a ton of time. So the idea with the session today is to give you real practical takeaways for when an SPA crosses your desk or an APA or whatever form of purchase agreement at the kickstart of a transaction, either because your side is holding the pen or because you receive it from the other side, or as you go through the stages of negotiations and receive markups. Of course, at the core, purchase agreement we view as sort of a legal document, but there's a lot of tie-ins there from the PE teams, from the deal teams, and we want to go through with you where to focus your attention most, how to sort of quarterback between legal and the business team, and discuss some of the areas that tend to be the most contentious, or where you'll see a bunch of push and pull often between counsel and between business parties, and to explain why that is. There's going to be a particular focus on the elements that help mitigate risk. Of course, at the end of the day, everything is risk appetite driven. And the idea is really to flow through many steps so that, in transactions you may have seen, especially in the younger groups, VP and under, you may have seen pieces of the puzzle in that one particular transaction had a particular negotiation issue. But the idea today is to really show you the broad sweeping terms of how that whole puzzle looks together. In an hour, we of course can't go through every single aspect of an SPA. You'll forgive us on that. And so there are other items which frankly could be a session on their own. And I'm sure, frankly, Claire and I would be happy to discuss that with you guys in a later session, or of course, other presenters that the CVCA so deems. Notes on what that would be is, for example, debt commitment letters in the context of a two-step transaction where funding is required. There's also discussions around debt commitment letters, equity commitment letters, a limited guarantee of the parent, and capping liability of purchaser, for example, with a reverse termination fee. We won't in particular be going through those today, but we wanted you to be mindful that those are other elements to this puzzle. So without further ado, I would turn it over to my colleague, Claire.
Thanks, Kiran. Okay, so instead of doing a page flip on an actual agreement, which I think, as we all have done, page flips on agreements can take longer than an hour, we tried to put the kind of areas we're going to talk about into different buckets. So I'm going to start in talking just about structuring the deal and the deal process right from the get-go, including backing it up before you even put pen to paper on an SPA. So if you're a PE professional, the first question is kind of when do you involve legal, and what gets into those preliminary agreements, whether that's an NDA, an auction process letter, an LOI, or a term sheet. And we understand that there's always the consideration of costs if to involve external legal if you aren't sure that you're going to proceed with the agreement. But there's certain things you should consider, and there's certain times that you definitely should consider including your legal team, because it can really help you from the outset. So on those preliminary agreements, I think one of the key things to do is that the term sheet or LOI doesn't just cover purchase price. And we know the PE professionals are, super focused on price, because that's really like the go, no go factor. But you always have to remember that your valuations and your assessments of purchase price are dependent on assumptions. And it's sometimes really important to get those key assumptions into the preliminary documents so that the parties are aligned. For example, if your valuation and you're a buyer, it critically depends on kind of 2 or 3 key long-term contracts for the target business. You may want to consider flagging right from the get-go that consents to change of control will be CPs in the main agreement. I know it's kind of detailed, but if it's critical, if 2 or 3 long-term contracts are critical, you'll want to get that into the agreement so that the parties know that if that's not possible, then you won't be able to proceed. You also want to flag, for example, like that it will be subject to diligence of these contracts, that the agreement has a condition to signing and to closing, that you have satisfactory diligence of the terms and termination provisions of these key contracts. Another example is if the buyer's valuation assumes that key management is going to stay on in a very involved capacity, but then management or the vendors are assuming that they are going to take their check, go buy a yacht, and peace out, then it's important to get those assumptions and alignment right off the bat, and not just focus on purchase price, but kind of the key go forward operational expectations of the business. So we can help you do that. We've done a lot of the preliminary agreements, and so you can engage a legal team, even just saying, hey, can you just flag a few high level things? We don't want a full redraft. We don't want to engage legal too much, but just flag if you think anything's really missing based on what we've done so far. And that's something like Kiran and I and our colleagues and other lawyers around the street do often. And it can really set you up for success if you've started from an aligned position. The one thing I will mention, if you choose not to use a lawyer at that stage, it's preferable to focus on the key business terms, but don't copy and paste in other legal language from previous precedents, because that could predetermine or suggest that you're more settled than you are on certain terms if you haven't had your legal team look at it. So if you are going to kind of proceed on just business terms, no legal review, stick to just the business and the numbers, and try to refrain from using legal language that looks right, just in case it isn't. And so from that, I think once you're ready to engage legal on the SPA, there's probably 4 or 5 key components that you'll want to have a good understanding of before you provide instructions, just so that you don't have your lawyers draft something and then say, oh, actually, we're going to do it this way, so you're going to draft again. So I think those are, whether this is a share purchase or an asset purchase. Those are 2 different agreements. And Kiran and I both have probably been in a position where we draft an SPA and then the client says, actually, no, can we make it an asset purchase? And that's a big effort. We can always do it, but it's a lot of time to take the concepts pre-agreed and switch it into the other modality. So yeah, figuring out whether it is going to be an SPA or APA right off the bat, very useful. Another kind of question that needs to be decided earlier is 1-step versus 2-step. Is this going to be a concurrent sign and close, or are you going to sign a purchase agreement, have an interim period, and then close? And often the drivers of that timing are regulatory approvals like competition or antitrust or investment review. the availability of your financing, if it's able to fund and close at signing, and then just your own diligence timing. I think legal diligence can always fit the timing, but if there's accounting diligence that is going to take longer, then that sometimes drives the 1 to 2 step process. Other key considerations are what type of consideration are going to be paid. So cash, prom note, rollover equity, vendor take back, some combination thereof. The better idea you have of that right off the bat, the less painful the share purchase drafting will be down the road. Is there going to be an earn out? Is there going to be indemnities and or adjustment escrows or holdbacks? Is there going to be one or multiple target or sellers or guarantors? Like, those are kind of little things, but they create a lot of drafting. So to the extent you can turn your mind to them and come up with what you think is going to be the answer so that it doesn't change on a dime and then have to get redrafted, super helpful. The last 2 factors are, is there going to be rep and warranty insurance? Because that will change the nature of a purchase agreement. And then are the buyer and seller contemplating pre-closing or post-closing reorgs? Because that will also have kind of a lot of structural effects on a purchase agreement.
Yeah, and something to bear in mind with respect to these structuring points is your counsel can absolutely work through these with you. And it's not just a matter of getting this settled to avoid drafting or redrafting, but it's also a matter of having a clear messaging to, let's say, your purchaser, to the other side of what the expectations are, what the asks are, to not have ruffled feathers if, for example, we're aware of a regulatory filing that may take a few months and that needs to be done, and they expect a closing within a few weeks. So it's really to avoid irritants in the business team's negotiation process. The dreaded word, I know many people dread diligence because there is a feeling that it's the long pole in the tent and expends a significant amount of effort on both sides of a deal, whether buyer or seller. I think the way a PE professional should see their role in diligence is with respect to engaging with their counsel is really one of quarterback. Because you may have engaged, for example, a specific technology advisor to do intrusion testing or something more hands-on with respect to tech. You may have engaged, a separate tax versus separate accounting advisor. There might be phase 1s or phase 2s that are being conducted by an environmental advisor. And really the idea is that all of this intel that all of your team essentially, I guess in this analogy, you're now the coach, goes to collect, needs to be used on the field. Something happens with everything that's done in diligence, and the interconnecting of all of those players is important for a few reasons. One, because there may be questions that overlap, and sometimes sellers have limited bandwidth to answer diligence queries. And so they may feel irritated if there's questions about, for example, deferred compensation or their banking arrangements, both in an accounting list and a legal list. So that interplay can be helpful to remove some easy irritants off the table. But also because what is relevant or the outcome of that cyber operational or intrusion testing, for example, well, at some point needs to make its way into the agreement. So these can't be distinct silos. These all do have to blend into a work product. And that is often your role, because there could be circumstances where you haven't advised counsel or have had discussions to the effect that there is, in this example, intrusion testing or something being done. Now, if that were to reveal something, a weakness or a concern about a weakness, that then ultimately needs to be addressed in the legal docs. And of course, you'll work through with your counsel as to the how, but really see it as you're the bridge between these service providers to ensure interconnectedness. Your counsel can absolutely be the bridge as well. It depends on your desire to be fully active in fulfilling that role, or to introduce your counsel to all these service providers and have them fulfill that role. Both tracks are entirely your call and fruitful in either case. At the end of the day, it's really to avoid vacuums of knowledge and to ensure that you have knowledge sharing. So you've done diligence. That's great. You've received DD reports. But now what happens with them? So essentially, when you're reviewing DD reports you've received or going over diligence results with your counsel, there's a decision to be made. We've done comprehensive diligence. Fantastic. That's great. But are there items that we need to address before we're ready to sign in the context of a two-step, i.e. we won't even sign without these are rather major? Or in the context of a two-step, are there items which will make conditions to closing, which we'll discuss further later, meaning, sure, we'll sign this deal, but we're going to write that seller needs to do this prior to close. And then is there items that are so big ticket, frankly, that they change your valuation of this company and warrant a retrade or renewed discussions on purchase price? Are there items that are so large that they warrant their own escrows, which we're going to discuss again later? And so that fix is quite an important exercise. And again, as a PE professional, one of the things I would say you should take away from today's session is really what many call the 100-day action plan or the post-close integration plan. It's easy to not lose sight of what has to be done pre-signing or pre-closing, or in the context of a one-step, just frankly needs to be done before you enter into the deal. It can be easy to lose sight of the go forward advice and recommendations. For example, you may have a counsel that says, look, we don't like the way they do X, or their privacy policy is not bulletproof. Do we see a risk for closing? Do we see something material here? No, but we recommend this be fixed post-closing. Well, things like that, once you're now on the your watch scenario, as opposed to the their watch, you will want to ensure that you're not essentially letting a weakness or letting a risk, though low, perpetuate now that it's on your watch, because laws and rules can also change over time, such that what was low risk pre-close, if you perpetuate it over several years post, can essentially alternate into a medium risk or more higher risk item. And then, discussing things we can do, there's also specific indemnities. This is a known issue. There's nothing we can do about it. We just know that this is a blemish on the company. The reps do not help us here because we know this to be a blemish, so we cannot have them say that something is not, or that something is entirely clean. And therefore, we have exposure here. We're still willing to close, but we're going to make them on the hook via a specific indemnity, such that if we get a claim for this post-close, the seller in this instance would have to indemnify us. A good example here, a simple example, is if there's an ongoing litigation. Well, you may be willing to acquire this business because of the assessment of the litigation. That's completely fine, but you wouldn't necessarily want to be left holding the bag based on any judgment or any outcome post-close.
Yeah, so that's super helpful. And I often suggest to my own legal teams is when you're drafting a diligence report, you actually flag the issues as, this may go to a purchase price valuation. This you may want to deal with a specific indemnity. This we should get, good reps on. So feel free to have those conversations with your lawyers or give them instructions to say, okay, please make your recommendations on whether we should have this rectified for closing, or whether, you suggest this is something that is low risk and can be done post-closing. So instead of just having a list of issues with the target, you have a list of issues and how to deal with them in your purchase agreement or after. That brings us to kind of our next bigger section, which is the purchase price and valuation, which is obviously the key section for your teams, for the PE professionals. And again, I like the word that Kiran used as quarterback, because as the kind of the person with the pen on this deal, dealing with your legal team, you have to make sure the key thing is to translate all of the models and the valuation you're doing onto paper, so that you don't have one understanding and then the paper says something else and you only realize that 5 months later when a claim is made. So really quarterbacking between the financial diligence and the valuation, making sure that it gets properly papered is the biggest job for your teams and our teams together. And maybe just to start, in terms of purchase price mechanics, this is something that tripped me up as a junior, and I think often can use clarification. But there's two concepts in a SPA purchase price. One is the purchase price, which is the total purchase price, which is adjusted after the fact based on claims. It's adjusted by working capital and debt. And then there's the concept of the closing payments. And those often have different definitions. And so cluing into those definitions carefully is is like really imperative, because sometimes if you just read the words and you see purchase price or closing price, you may not be thinking of the concept in the right way. So paying attention to those and making sure your teams are also paying attention to those is a really useful endeavor. So in terms of calculating the purchase price, anyone who's seen an SPA knows that there's often a range of purchase price adjustments, and it's typical to see an adjustment for working capital, for debt, and for transaction expenses, as well as some other things. The legal team, so from our perspective, we need you guys to help ensuring the financial definitions and accounting principles that the M&A advisors and the business teams are using in their accounting methodology are accurately reflected in the agreement. These are often contentiously negotiated, and the lawyers aren't always in the details or have seen all the financials or understand even how to read the financials as well as you do. So being that quarterback and providing input on the financial definitions and the accounting principles is like super key. One thing in particular to be important, that is important to be attuned to, and this is even at the prelim stage, and this came up recently, was, for example, if something says it's determined in compliance with GAAP and past practices, that sounds right, but it doesn't always cut it in terms of specificity, especially if the target financials aren't audited, because GAAP isn't necessarily prescriptive enough. And if the buyer's accounting principles don't align with the seller's accounting principles, it's better to actually like set out the specific accounting policies so that you have those discussions before you sign and close, rather than down the road when there's the post-closing statement and you're arguing about different accounting principles at that point. We always suggest using an illustrative calculation, which has the parties turn their mind to it, but the kind of principles and ranking of GAAP, past practices, and specific accounting principles is something that is super useful to think about right from the get-go. Other considerations that you should be thinking about and talking to your lawyers about is, does the buyer and the business need a target working capital or target cash to support operations or limit cash funding requirements? Those are different structural things. So if that's a concern, then there'll be different concepts drafted into the purchase agreement. You'll need to think about closing date, whether completion accounts are even possible mid-month, or does it need to line up with end of month timing? Oftentimes we don't think about that until too late. We get to closing and we realize, no, it's not even possible. There needs to be an inventory done, or we need to do it with end of month. Otherwise it's a huge work stream for the people on the ground doing the accounts. It's not going to happen. So thinking about kind of like who needs to do what from a completion accounts perspective, better to think about earlier rather than later. And even at the timing perspective, in terms of closing timing, nobody often turns their mind to like what the time of closing in is an agreement, because you're like, okay, whatever. But if you confirm closing when funds land, and that's the definition of closing, but the accounts are done as of midnight the night before, what happens if one of your workers in your manufacturing facilities gets injured the morning between the midnight closing accounting and the 3 p.m. closing? So being attuned to kind of when the baton is handed in terms of sellers' accounts and buyers' accounts is super critical, because the lawyers often don't have the insight as to what's happening on the ground and when the accounting timing is being done. So asking those questions is super key.
And I know, bear in mind, we know we're throwing a lot at you, but the idea is to show every aspect where the PE professional's role clicks in. Legal counsel that's well attuned, and same with accounting counsel that's well attuned to your business and your objectives, is going to ask these questions. But we're just giving you a primer of where your input, you can already start thinking of your input before you get to that question, or see the whole, essentially see the whole puzzle again. I'm really living or dying on this analogy. Want to talk to you a bit about rollovers. So we talked about purchase price. Now, as Claire said, purchase price can be simply payable in cash, or you can have a rollover metric. Now, if you have a rollover and you're going into a situation where you have a rollover because of funding dynamics as well, you want a portion of the seller buy-in, to reach the EV you have in mind or what have you, to not have to draw on more debt or bring in more equity into your acquire co. There's some things to think about right at the outset. One of it is, they're going to ask for some level of, if you're a purchaser, seller is going to ask for some level of reverse DD. So at a minimum, they're going to want to see financial statements if they're coming into an established portco as a buyer. Of course, if this is a new investment you're making in an empty shell, the story is different. The financial story is really the business you're acquiring. But if this is something you're adding into an existing investment, well, then they're going to want to see the bigger pie. They're going to want to see the financial statements of the operating vehicle you already have. They're going to want to know what shares they'll hold, what the share rights are. They might ask questions about, material contracts and suppliers. As a purchaser, you have to be mindful of when this is done and that you did have a mutual NDA at the beginning, or that you now come and get a reciprocal confidentiality agreement, because of course you're still negotiating your deal. And you want to make sure everything you give is covered. A purchaser also wants to make sure they're somewhat aligned with deal terms before they open the proverbial kimono, so to speak. That's a consideration to keep in mind. The other elements on the table for discussion and negotiation in this case will be a shareholders agreement. Again, if you're buying in an existing platform, they're coming into that one, they're going to want to see it. They may try to reopen some negotiations of rights for themselves. If you're setting up a new investment, well, you're obviously putting in place a brand spanking new shareholders agreement, which again, sellers and sellers counsel, if we were them, of course, would want certain rights, certain coverages, and you're going to have a lot of input and negotiation on that as well. And then there's also the structuring component, because if you are acquiring a business that's an add-on and you're acquiring it in a vehicle that is an American portco of yours or Canadian portco, and now you're going cross-border, such that you'll have the opposite residency of rollover shareholders. So sellers are American, coming in, getting rollover shares in the top co-parent that's Canadian. There's tax considerations there. Same would be true with the inverse metric as well. And then, like we mentioned, some of the places where you may get stuck in a bit is seller may request from you certain puts, a certain right to be able to be bought out at a certain point in time to get their liquidity out. They may try to get a put at, X year mark or upon the occurrence of Y event. With a seller hat, understandable why at some point certain sellers will want to be able to pull out their liquidity. With a buyer hat, you don't really want to be at the mercy of a certain point of time or seller. You may not necessarily wish to be at the mercy of a seller triggering something where you now have to take liquidity out of the company to buy them out. So these, again, are dynamics that sometimes warrant really getting a shareholders agreement term sheet started pretty early in the process, so you can align on big ticket items in the early days. I want to talk to you a bit about another place that tends to have significant push and pull with a significant interplay with the accounting, not only diligence, but future plans of the business and really business dynamic, which is earnouts. So if you had to bridge a valuation gap between seller and purchaser by putting in contingent consideration, meaning, you will receive this additional purchase price if you meet X, Y, Z threshold. There's a few things to keep in mind there. And again, some of this skeleton of this you want to have baked or have business discussions on pretty early on in your process. One of which is, okay, well, what does that look like? Is that based on revenues? Is that based on maintaining or renewing a certain amount of portfolio? There's certain businesses where you want a certain number of contracts in or a certain amount of commissions revenue maybe to come in. It could be based on EBITDA. If it's based on EBITDA, is it based on adjusted EBITDA? And then what falls in those adjustments? So to give you an example of things that would be adjusted for and you would want to provide in your purchase agreement, so that you're not having a debate on whether the earnout was earned or not post-close, because you have a true mechanism for it, is, for instance, management fees. If the PE is coming in and putting management fees, seller is going to say, well, we're adjusting for that because I'm not going to take the hit of that. But now with my purchaser hat, well, what if that's replacing operational fees you already had pre-close, and it's just now me with my purchaser hat that is able to come in and give you that same service? So there's, some dynamics there. Another example, an easier one is, transaction expenses. Another one to bear in mind from a purchaser standpoint is, well, if we get accretive EBITDA, if my goal here in buying this company is to then have it be acquisitive and go do add-ons in it, why would I necessarily, seller, give you the benefit of the incremental EBITDA I'm collecting because we essentially paid for it by acquiring these other businesses? That doesn't go to you having grown this business to reach the revenues or the EBITDA targets that we had set out. And then really, where we tend to see a lot of push and pull is, what is your plan if with purchaser hat on, and seller will be just as concerned about this. What is the plan that purchaser has for this business post-close? And what can purchaser bring to this business post-close? If, for example, purchaser brings synergies because they have significant, I'm just throwing one example at you, they have significant volume rebates with suppliers. Well, purchaser brought that. That wasn't seller creating value or saving or creating savings in the business and running leaner. That was essentially a gift by virtue of purchaser's existence in the puzzle. And so that's an item purchaser may want to carve out from this EBITDA. But from a seller's perspective, if purchaser has, a good example is, let's say, multiple clinics, say multiple medical clinics, and purchaser is going to be sending referral business, while seller is going to be very concerned with, well, what if you're sending that to the place 10 kilometers down because there's no earn out there, and there's going to be dynamic of, when does that referral business come to me, when does it not? Again, all these things holistically that need to be considered in the context of an earn out. And one of the biggest ones, frankly, the biggest one in my view, is, what are the operational covenants post-close? This is all fine and dandy that we have a share purchase agreement in our hands and that we've closed. But if I'm a seller that's retained as management post-close, I'm going to want to have some comfort to run the business in a way that gets me to that accretive contingent consideration and gets me that earnout money in my pocket. And depending on the industry and depending on the transaction, I may say, for example, and this is a tough sell for a seller, but I'm just throwing it out there, tying up employment or tying up the sales force so that I don't lose sales force people if that's what's pivotal in my business. Now, from a purchaser's perspective, again, there's a bit of push and pull here that's natural and intrinsic, is that I've bought this business, I want to grow it, there's a lot I want to do. I don't want to be overly handcuffed in what I can do post-closing. And so there's a dynamic to reach there as well, as, am I giving you firm covenants for how I, purchaser, I'm going to conduct this business post-close? Or am I simply rather giving you a concept, for example, I'm not going to do anything that I need scope to run the business as I see fit, because that can evolve over time and look different 1 month post-closing than it does 1 year after closing. But while covenanting to you that I won't take any action that's designed to impact your earnout. So those are some things to keep in mind there on earnouts.
In short, earnouts are complicated. Okay, so we talked a little bit about kind of purchase price valuation and structuring the deal. Obviously, a big part of a purchase agreement is reps. And I'm not going to talk about them kind of in detail because I don't think we have time for that. But the critical task between a business professional and a lawyer is making sure that you're both reflecting the business correctly, that if you're on for the seller, that you're describing the business correctly and you're getting all the facts into the disclosure schedules. And then the reps and warranties are a risk allocation mechanism. And so as a business professional, if you're on for the purchaser, if you're the purchaser, the key thing you can do to help your lawyers is to flag where the business value is. We can send you, 50 pages of reps that are the most comprehensive. And, Kirkland & Ellis has been drafting them for years, and they say everything under the sun. you guys don't necessarily want to do that for, a mid-market deal, for example. So helping the lawyers understand kind of what the value is you're trying to protect and where the risk is in your valuation is really helpful for us, so we can make initial kind of structuring comments and recommendations on the reps and warranties. The M&A team, like Kiran and I, will have a bunch of specialists, and we'll decide whether it's necessary to engage them. So if you have no concern about IP at all, if like the company doesn't have trademarks, you don't care about the trademarks, you really just care about the employees at the target company, if you say that to us, we're not going to engage, 10 privacy and IP specialists to talk about data and trademarks and copyright. We're going to focus on our employment team providing advice on employment. So that's kind of one of the key things you can do, is translate that business value. And then we'll go through the reps with you and get a feel for kind of what's important, where the risk is. I think like this is both a disclosure, as I mentioned, and a risk allocation exercise. Where we end up negotiating on the reps the most is the risk allocation, and we do that normally using qualifiers. So the buyer wants to buy a company with no liability, and the seller wants to sell and walk away. Where this comes down to a negotiation is unknown things, or immaterial things, or things in the ordinary course. So, for example, I'm going to kind of run through in terms of litigation reps, how those are qualified and what the positions are. So for a litigation rep, buyer is going to say that anything pre-closing should be on the seller's account. And the seller's going to say, if I didn't know about pending litigation, it shouldn't be my account. You're buying the business. And so that's where you're going to see kind of discussions about how a knowledge qualifier can allocate risk for unknown things. Similarly, with materiality and ordinary course, the seller's going to say, if I have a million frivolous warranty claims all the time, and they're immaterial and they're ordinary course, I don't want you to make indemnity claims afterwards if they come to light a year after. The buyer's going to say, I don't care. I don't want to buy a business with existing claims. So the negotiation is going to be in that what's material, what's ordinary course, and whose responsibility ordinary course claims could be on a litigation rep. Similarly, you can use the look back qualifier. So a seller is going to say, like, I don't want to have to tell you about all previous material litigation, because there's a disclosure burden too, right? Like the disclosure schedules can't be 1,000 pages. There has to be kind of some cutoff at some point. So they're going to say, I don't want to give you the full history. I'm going to tell you everything in the last 6 months or since my last financials. And the buyer is going to say, okay, like maybe not forever, but the business and revenue effects of, for example, a material litigation that happened last year could still be panning out. So I just want to know about them. So your rep should at least cover them so that I know about them, and that can affect my understanding of valuation and my operation of the business going forward. So those are kind of like the key qualifiers where we get into the most negotiation on reps and warranties. And then the other thing to mention is I've just talked about kind of business reps, but you'll also need to have vendor reps to make sure that the vendors are the vendors. And if there's rollover equity, you'll also have to negotiate reps, like at reps and warranties of the purchaser, because anyone receiving rollover equity is going to want to make sure that the company they're getting equity in, their purchase price is in shares, that those shares kind of have value. So there's a lot of work streams on this, but that's kind of reps and warranties from a high level.
So we want to talk to you a bit about deal certainty and interim period covenants, or closing the deal, frankly. So in the context where you're a seller or purchaser in a two-step deal, we're signing at a certain day, things are going to happen, and then we're closing at a second date. Well, one of the matters that's neither a rep nor any other aspect is, how is this business going to run during that interim period, that period between signing and closing? And so as a buyer, you're going to want to put in a slate of both positive and negative covenants. Positive covenants for the interim period: here's what I want you to do. Run the business in the ordinary course, keep the insurance policies in place, other things that are active actions for them to do, positive actions. And then there are negative interim covenants. Do not, for example, change the accounting principles used by the business do not engage in CapEx over X amount. Do not settle a litigation claim without me. And why these do nots, do nots, do nots? Well, some of it goes to valuation. You set up a purchase price based on something. You set up your illustrative calculation based on something. If the script is rewritten because they're changing their accounting methodology, or they're buying a business in the interim period, that they're going to turn around to you and say, well, when you buy us now, you're buying something bigger. The game has changed here. The pricing has changed. That doesn't work. It changes the picture, the snapshot you took at the signing date and expected to be true later on at the closing date. And so you list all of these things that you want them to not do, and your lawyers will put in a standard list, but there are certain aspects that you will need to feed into, because, for example, maybe there are positive things you wanted them to do during the interim period. Maybe they're opening a new greenfield location and you're okay with that happening, and that's happening during the interim period. Maybe there is a change in accounting they've already told you of and that you're permitting. So we would bake in not simply do this, don't do this, but here's what we want you to do, and specific things we don't want you to do. And in every case, of course, this is without purchaser's consent. Don't do these things without coming to talk to me first, because it has an impact on what I buy on the closing date if I'm buyer. Now, if I'm seller, and I change hats and change teams here for a sec, depending on the length, there's a correlation between the length of my interim period and how much I'm going to be willing to have you be sitting on my shoulder as purchaser, engaging in all of these operational questions with me. The longer the interim
Especially if there's a
period,
risk that it doesn't close still.
so the longer the interim period, the less likely I'm going to want to let you put your nose in all manners of affairs. And the shorter the interim period, the more I may be okay with that. And again, to Claire's point, if we're having a long interim period because, for example, there's a CFIUS, HSR, Competition Canada, any form of review, an FCC telecom review, whatever it may be, if there's a regulatory filing or regulatory filings around the world, and you're looking at about 12 months, well, it's a very different script if you're a seller, because you're seeing this as, well, wait a second, I can't grow or I can't run my business in the interim. And what if it doesn't close and I've sort of waited around and been at the mercy of someone else in the interim period? Again, we're giving you the black and the white. There's, of course, every shade of gray in between these positions. But that's sort of the script. Another simpler example is, well, of course, I'm going to say don't go incur new debt, because the whole point is we're going to get a payout letter. We've figured an illustration based on a certain amount of debt. You're going to go get more debt. I need yet another payout letter, which I didn't necessarily have baked in that particular lender in my purchase agreement. So while they don't go to deal certainty, well, closing certainty as such, they do go to how one feels about closing certainty, depending on whether they have the seller or purchaser hat. So important to share any intel you have on the running of the business with your legal team. There's also, and we're going to talk about conditions precedent, so what the conditions are to close just in a little bit, but one of those conditions tend to be everything else you have to deliver. So at closing, you're going to have to deliver, for example, the signed shareholders agreement, the signed employment agreements if we're entering to new key employment agreements. Something to keep in mind for a two-step, both seller and purchaser are aligned on this. You very, very much want to limit where your transaction's destiny or fate is in the hands of a third party. So, for example, if there is if you want to enter into new employment agreements with senior execs, and they're not all seller parties that are going to be at the table and in the tent with you, then they could be negotiated pre-signing and signed, effective on the closing date. They don't need to be put in place or effective at the moment they're signed, but that could be baked in. Or, for example, USA, and this is a related party, but, if you have an employee that's going to get shares, a transaction bonus or whatnot, and they're going to be a shareholder too, well, you want to know already that they're signing the USA in the form that's attached to your SPA. So you really want to limit where third parties can kind of undo your transaction, because in the interim period, they could show up and say, well, I don't want to sign this. I don't want to do this. a couple ancillaries that I want to talk about in a bit more detail. Certain times there are their own standalone document, and in certain instances, they're part of your purchase agreement, are non-competes and non-solicits. So putting my buyer hat on, I'm buying this business. I don't want you as seller with your seller hat to compete with me in this business, because that dilutes the value of what I just bought if tomorrow you can go across the street and set it up. I know you're all very aware of non-competes and non-solicits. The point I want to stress here are a couple. The first is properly setting out what the business does is important. And properly setting out if they're currently engaging in a new business line or working hard to grow the sandbox of what they're doing now. If there's ancillary parts that they're adding on, that they're working on. Because again, you have to tell them, and the document has to tell them what they are not allowed to do. And so what that is a construct that's baked together between council and the PE team. Another thing we discuss often with clients is the parallel tracks, because you're going to, whether you're on sell side or buy side, see that you have restrictive covenants with non-competes, non-solicits in your your share purchase agreement, in your shareholders agreement, assuming they're coming in and rolling over, and in your employment agreement, if you had this person sign a new employment agreement. And we often get asked, well, hold on, how do these all intersect? Think of them with different hats. The seller, when they're selling in the purchase agreement, has their seller hat on, and they're telling you, I won't do this exact thing that I'm doing today. The state of the business today, I won't do this for 5 years. It's a straight shot, 5 years or 3 years, depending on the amount, or 2, depending on the amount of consideration they get and your deal. An employment agreement is saying, as long as I'm employed and for X months thereafter, I won't compete. It's a different track. This person could be with you as an employee for 8 years. Your first non-compete that was 5, let's say, from closing has fallen. It's no longer on the table because it expired at 5 years. Now you have your employment one that will still apply. And then your shareholders agreement one should catch the nature of the business when this person ceases to be a shareholder. So let's pretend we're at year 10. And they haven't been an employee for a couple of years. Well, you don't have the seller hat non-compete anymore. You don't have their employee hat non-compete anymore. All you have is their shareholder hat non-compete. And it's important that that one not be set based on what the business was when you bought, but based on what the business is and what it does when that person's coming out of the shareholding. And that one is ticking in from the period the person ceases to be a shareholder. So again, that can take you, in my example, from 10, they cease to be shareholder at year 10, that gets you a non-compete that kind of goes till 13 in this example. So that's really, look at them with the parallel hats: employee hat, seller hat, shareholder hat, and they're all distinct. And sellers, rightly, particularly if they're selling, if the buyer is a PE seller and the seller, forgive me, if the buyer is a PE buyer and the seller is not, and this is the one and only time they're selling a business that they put together, they're not necessarily always attuned to that distinction.
So, Kiran spoke a little bit about some of the ancillaries and the interim covenants. I think from a deal certainty perspective, the kind of overarching question, are these things that you'd like to have? Are these things that you need to have? And how do you qualify that? So what you'll often see is deliverables, but then you'll also see covenants that have a standard of effort. So, for example, landlord consents to change of control. If a business has, 30 different retail operations, and technically landlord's consent is required, and there's a $200 fee when there's a change of control, you may want them because you want to be not in breach of your landlord, your leases, but you don't want to go out and get them all for closing. So often where we align in the middle is that there'll be some sort of best effort, commercially reasonable effort to obtain them. And so from a PE professional perspective, you're going to want to think about kind of which things are critical and which things do we want them to have. And then you're going to need to manage you're going to need to move, like Kiran spoke about at the beginning. If something comes off as rectified for closing, you're going to need to make sure that goes into your post-closing operation fixes, so that you don't lose track of something going forward. So the standard of effort is kind of the key thing that qualifies whether it's a strict deliverable or it's an effort. Similarly with the reps, if it's a two-step, you can have a bring down of the reps be true and correct as of closing, but often you'll see the reps qualified as in all material respects, or they can be inaccurate so long as there's no material adverse change. And often the lawyers will argue a lot about that because you get your protection from the reps, but if they don't have to be true as of closing, unless there's a material adverse change, then really you have to close with a rep that's not true as long as it doesn't have a material adverse effect on the business. So it can lead to, even if the reps exist, not having the reps all be true, which is a different paradigm. I think then that brings us to risk allocation, which is the fun stuff that Kiran will talk about.
Oh, the fun stuff. The stuff you hear a lot about, whether you're seller or buyer, the stuff you're going to see a heavy markup on and a fair bit of back and forth, a lot of wood to chop on risk allocation at the end of the day. So a few things to cover here that, again, you've all seen peppered through agreements, but we want to, again, give you the full pie of how it all interplays. So we talked about reps. That's great. Seller is holding their hand to the fire and making certain promises. They're qualified depending on how they're qualified. Great. I have these promises. Okay, well, what do I do with them at the end of the day? And how long do they live? So the first piece is the survival. They held their hand to the fire. They made these promises, but really to what extent? So there's separate survival that you typically see. The buckets are how long do the fundamental ones survive, which tend to be a handful of reps, limited to a handful of reps that honestly, but for that, you've essentially bought nothing. For example, I, seller, have the capacity to sell you these shares. I actually own these shares. So really, these are, if they're false, these are cataclysmic events, almost never seen, and really, frankly, earth-shattering events. So those, let's say, call them 4, 5, 6, depending on the instance, reps are fundamental. You'll typically want those to live for very long. And there's discrepancies on that depending on whether you're talking about a US deal with PEs on both sides, a cross-border deal, or a pure American deal. You may see somewhere between 3 to 10. You may see indefinite survival. So that really depends on where we are in our deal dynamic. Then there's the regular rep survival, call it all the operational reps, business reps. You tend to see 18 to 24, 12 to 24 months as the most frequent, again, depending on deal dynamics. And then you've probably all seen one that says based on prescription under law. So for example, if environment is really important because Target's manufacturing stuff is actually a maker and not, people in an office that are service providers, well, then environmental will be tied to often surviving based on how long a claim can come after the company, and same for tax, the reassessment assessment periods. All of this changes somewhat depending on whether you have a rep and warranty deal or not. Because if you have a rep and warranty deal, you can get longer survival under your insurance for fundamental and get coverage for pre-close tax and tax reps for longer than what the seller is giving you. So if it's a really contentious deal, you may choose to loosen the survival the seller gives you because you have a backstop. Additionally, you may say that you're content with just reps and essentially be capped at the insurance instead of coming back to the sellers if you had a loss. Because at the end of the day, it's about a loss. So a rep was made, I'll keep a simple one, there's no litigation. Turns out, my goodness, there was a class action. Everybody and their dog knew. Again, this will unlikely event, but I'm just using this for the sake of example. Well, now you've had a loss as buyer, and the question becomes, it's a breach of rep. So you may have in your deal said, in order to have a competitive deal, I'm willing to limit the breach of reps to my rep and warranty policy, or you may have a look back to them. It all depends on how you structure the deal. Bringing in rep and warranty insurance in this way gives you a dynamic to essentially reallocate the risk discussion and reallocate somewhat the rep discussion, because if you're saying for breaches of reps, I'm capped at the insurance and I have no look back, and you're not sharing in my retention under the insurance, the deductible, seller, you're not on the hook essentially for anything. well, then I may want a fulsome suite of reps, and we may spend significantly less time haggling on the qualifiers of reps that Claire discussed earlier. So at the end of the day, in terms of mitigating risk, we've discussed a few of them, but I just want to wrap it up. There's the reps, because I don't know of an issue. I want to make sure I'm covered for it. The rep gives me this. The rep does not give me that if I know that rep to be false, or I found something in the diligence that doesn't shake out. There's then the survival. How long do these promises live for? How long am I covered for? There's who do I have claim to? Am I just to sellers, in which case we discuss what the cap on liability is with sellers, or do I have a rep and warranty deal here too, where I have the insurer as well at bat? You know, and then for the seller's point of view, what limitations am I going to put on this? Because you know what, hold on a second. If there is, let's say it's not a rep and warranty deal, not a rep and warranty insurance deal, forgive me. Well, a seller's going to say, if you have a claim under insurance, whether it be the cyber or the commercial coverage, I want the claim to be set off against the amount you recover in there. Or if you get a tax benefit that flows from this loss, well, hold on, I want that tax benefit to be deducted from what you claim from me. So it's really getting the right mix of that push and pull on both sides. And yeah, I'm sure you've all experienced this or heard this before. It's one of the first things one hears, I think, in PE, and I think it's very relevant. A good deal, neither party thinks they want everything, because if seller thinks they got the deal of a lifetime, then so if buyer thinks that, seller's somewhat been had. And if seller thinks that, buyer's somewhat been had. The best deals, both parties leave feeling partially satisfied and not entirely so. There has to be compromises at the end of the day. So with that, I cannot express how quickly this hour flew by. I know we went through a lot of material. Let us see what is cooking in the Q of A. Yeah, the tariff situation, that brings up a really good point. That is, I think, having the most impact when you look at two-step transactions. Because the same way in the COVID era, so if you recall the height of the 2020 lockdown transactions, where you know, people wanted to carve COVID or other COVID-like events out of MAC, or say, you know, we're able to run the business in the ordinary course absent, you know, other than COVID, because so much was evolving. Similar things coming up with tariffs now, in that as a seller, I won't want that to be a MAC or to be anything that hurts my deal certainty. Whereas as a buyer, if you've signed a purchase agreement, and ultimately, because you see this as evolving day to day, this tariff conversation, if by the time you get to closing, the landscape of this business is so vastly different. So really where we see the tariff discussions coming into play a lot right now are in closing certainty and the ability to walk or not.
And I think the point on that is that there is something that you know is contentious, get it into the purchase agreement. Don't rely on interpretation of a MAC clause. Draft it right into the MAC, the material adverse change clause, or have a provision that says if this happens, then this happens. The purchase price will be adjusted. So the more specificity you get on a known question mark or a known risk, you should get it right into the purchase agreement so the parties are aligned.
Great. Well, thank you so much, Claire and Kiran. We've had a very dense, very robust conversation, all of these detailed insights that I'm sure our members really appreciate. I particularly enjoyed hearing all the intricacies and all the details around M&A. So thank you for your presentations.
Our pleasure. And if I may, Adriana, there was, I think, a few questions we didn't get to. Feel free, those who asked those, to send Claire or I an email. We'd be happy to. We apologize, we went slightly over our time, so we're happy to answer those by email for you.
That is great to hear. Thank you for that. And so once again, just thank you, and thank you to FASKEN for your partnership on this webinar. And thanks to the audience for tuning in and for submitting your questions. As our speakers mentioned, feel free to send them on email, and our speakers will be happy to respond. And just a comment to please watch your inboxes for more information on our next CVCA webinar, which is going to be on the subject of life sciences, and that will be taking place on April 10th in partnership with Biotech Canada. And once again, just a reminder to register and join us in Calgary in May for IC25. So thank you. I wish you all a great afternoon and see you later. Thanks.